Okay, let's pull up some data about some very concerning news that's coming out regarding Bank of England's warning about hedge funds that have essentially accumulated about £100 billion in bets on UK gilts. And let's break down why this matters.
And bet on small changes in the price of these gilts. The challenge is that if you have a crowded trade, that means that there with a small number of players, there's a risk that if there is something which makes these players nervous, they all unwind the trade at the same time. And because it's leveraged, the trade is much bigger than they are, and that has a financial stability impact on the gilt market. So we've had this. Some of the regular listeners will know this has been a factor for the US Treasury markets for ages. There is a multi-trillion-dollar on and off trade around the US Treasury market basis trade, which has unnerved global regulations, and the BOE has previously warned on that. Their concerns are now closer to home, and I guess the fear is that if there are unpredictable price moves or there are political issues or anything which makes people want to rebalance, that then.
So basically, gilts are more or less UK government bonds, okay? And essentially loans investors make to the UK government in return for a specific interest, a set interest over a period of time, and then a repayment of the principal, right? So it's generally seen as one of the most safest assets because of the government is highly unlikely to default, especially like a UK government. Strong GDP, well known for its democracy, financial system, regulation in place in terms of oversight. So this is the reason why there's cause of concern now. So basically, hedge funds essentially trade gilts using strategies like basis trades, which you just mentioned, which involves borrow cash from banks using gilts as collateral. They then use that cash to buy more gilts or take related positions off of the hedge and futures. So it involves leverage intertwined in this.
Leads to a potential disorderly unwinding of the trade, and that can impact markets. The challenge is there's not a ton that the Bank of England can do about it. I mean, they can warn about it. They can say, we think hedge funds should adequately manage their risk. I doubt any hedge fund is sitting there thinking, okay, I'm going to engage in some inadequate risk management today. So it really is just a question of calling attention to it, making people conscious of it. They can maybe Another part of the Bank of England can make sure that the banks themselves are being cognizant of the risks which they are allowing hedge funds to take, and making sure that any lending they're doing, that they're managing the lending. But beyond that, it is a case of wait and see. I mean, we've had massive concerns about the US Treasury's basis trade for quite some time, and the basis rate has not come down during that time.
So basically, this 100 billion in terms of the bet that's taken place, this is actually the highest on record now. And there's a leverage concentration. So it's not as if it's concentrated spanning over 50, 100, 200 hedge funds. No, there's a small number of hedge funds that are primarily focused on this strategy, this bet, right? An account of a 90% of this borrowing. So there's a high leverage play, there's a high risk, which then involves the potential for high returns, right, to the upside, and also to the downside losses. But there's a market impact risk that's also crucial that one needs to take into consideration.
Yeah, but a very interesting warning nonetheless to keep an eye on, as you say, Laura, even if the bank's powers are fairly limited on that. But one of the things the bank has also been publishing some data on is the stress tests of the UK's largest lenders, all seven of the biggest banks passing the stress tests. What's your reading of the outcome of that?
They did. And do you know how long it's been since a bank last failed the UK stress tests? Quiz for you there, Stephen. Take a guess.
Well, what, 2009?
No, it was actually more recent than that. 2016. But these days, almost nobody fails stress tests. So we are very, I mean, it would have been a big shock if anyone had failed a stress test, but it's pretty much impossible now because banks are so closely monitored. Their capital is monitored on an ongoing basis. But the stress tests is another reassuring sign. It does lead me on to my favourite topic of the day, which is the UK bank capital revamp. So what the Bank of England also announced this.
So I think you need to take into consideration what's in it and why is this alarming for that. So if we basically just pull up some details here, you can clearly see this individual basically just mentioned regarding, if I can find it, here it is. The UK, these are your pensions, they're putting at risk. Hedge funds have placed 100 billion bet on gilts that the Bank of England essentially believes that has left basically Britain dangerous and exposed to the bond market. So the governor of the Bank of England has warned that volatility in the bond market is unavoidable. Officials are now concerned that trading by hedge funds could pose risks to the financial system. They face less regulatory scrutiny than banks, but control a growing share of global money, right? So if you then take a look into consideration, there's a systemic risk on the rise that if these trades unwind abruptly, then it could have a catastrophic effect and impact on those that basically are holding these positions, i.e. pension funds also hold, right? And also individuals that are literally holding these bonds for this fixed returns based on that period of time. Also, concentration that we mentioned. If hedge funds basically need to reduce positions quickly, there could be a shock in terms of the price that one needs to also be aware of. So if you take a look at the interconnection here, is that rising gilt yields, and if we just pull this up, you can be able to see this. This is a breakdown of the yield on a 10-year gilt. So Liz Truss, the previous Prime Minister, that was the min budget that came out towards the end of 2023. And then we're currently seeing at these, crazy levels at the moment. And this individual's basically just saying that that under Starmer, the currency stands at 4.5%, and the government borrowing has actually spiked. But where this can potentially go wrong, where I feel, is that hedge funds hold these heavily leveraged positions, yes? And this could obviously have a shock to the impact politically wise, economic wise. Gilt prices could fall, right? And leveraged positions get stressed. And then you probably get margin calls that will obviously take place. So that pushes price down, right? Further, and potentially forcing others to sell. So you're getting this a feedback loop that's also taking place. So I believe there has to be an oversight of somewhat that the regulators put in place to manage this. Obviously, they can't do anything because it's just a standard leverage bet, unless they start putting restrictions on the leverage that you can take. But I don't see that happening. And then the question is why now, right? Gilts have been relatively attractive versus other assets amid high yields, right? Because obviously interest rates have been has really been quite high. So it's been quite an attractive proposition. Banks have eased back from traditional market moving roles, leaving more room for hedge funds, and hedge funds are out there playing and enjoying themselves. So essentially the bottom line is hedge fund bets on UK government bonds are very large and highly leveraged. Be aware of the risk and sudden unwinding. And these are things to take in consideration from someone that has no clue about what's happening in the financial markets to someone that's actively investing in getting involved. These are things that you need to be aware of because there could be a potential black swan. So if you like some information, please like, subscribe and follow, and I'll come back to you another one. Bye-bye.